Hello, everyone, and welcome to our installment of Meeting of Manager Minds. I am your host, Msizi Msomi, a portfolio manager on the global and specialist portfolios. And we always try to bring you the best insights from managers. This speaks to our strong manager research capabilities and our strong AUM. We're currently sitting over 730 billion worth of assets under management, and that speaks to the pedigree of the asset management industry and the big footprint that we have in terms of leveraging of the best minds out there. And today I've got Paul Robinson from Laurium Capital. He's a portfolio manager on the Africa strategies, and Africa has been coming into headlines as being an opportunity and also a risk from different points of views. Welcome, Paul.
Thank you, Susie. Thanks. It's great to be here. Appreciate it.
Awesome. Now, tell me a bit about yourself, before we get stuck into, kicking the tires on Africa. Who's Paul? Why Africa?
Yeah.
And who's Laurium? For those who don't know.
Sure. So I guess to start, I've been at Laurium for probably about 16, 17 years now. Laurium was founded in July of 2008.
Okay.
I joined kind of Feb 2009. At that time, Laurium was purely focused on South Africa. But very quickly, within a couple of months, we started looking at African equities as well. When I say Africa, when I speak Africa today, I mean Africa ex-South Africa.
Yes.
Very different opportunity set. It's been a great journey for me looking at these African equities, at this asset class for 17 years now. Seen some incredible changes, some ebbs and flows. Yeah, it's definitely been, for me, an interesting space. You ask why Africa.
Yes.
And a big part of it is just interest. I've always been interested in the continent from a business point of view, from a money-making opportunity for investors, from a travel point of view. So I've been incredibly fortunate to mix interests with work.
And maybe just a bit about yourself now. How did you get into this space, investing, being a portfolio manager? If you weren't a portfolio manager, what would you be?
Good question. So I spent a bit of time after university in overseas, London, for a couple of years. I worked for an investment bank there as just on their trading desk, trading assistant, and then really started enjoying the investment side of things there. Before then, I'd always been interested, but it was nice to actually start working in the industry. I then went to Dubai for 2 years, worked again on the investment side there, decided I wanted to come back to South Africa, did an MBA through the University of Cape Town, was fortunate after that, fairly soon after that, to get a job with a hedge fund, a small hedge fund here in South Africa, in Johannesburg. During the global financial crisis, that fund shut down, and roughly at the same time, Murray Winkler and Gavin Forberg were starting up Laurium Capital. So myself and a colleague, Kevin Shane, we moved across from the fund we were at to Laurium Capital, and it's been really good since then.
If you weren't a portfolio manager, would you be like a surfer or a doctor?
Sure. I've always had an interest in science as well.
Okay.
So in another life, maybe would have done more stuff on the kind of science, technology side, some kind of scientist role, I think.
So, Paul, when people talk about Africa, they speak about big opportunity, big risk.
Yeah.
What's your take on that?
I'll start with the risk. There's amazing opportunities. We'll get into that. But on the risk side, there's no doubt there is risk. And in compensation for taking on that extra risk, you should be paid more.
Yes.
You should get good returns out of Africa. But it's not to say it's not going to be lumpy. So
Yes.
the overall story is definitely very much in place in Africa. The demographic trends, the formalization of the business environment, the improving of institutions, both if you think of central banks, ministers of finance, presidents, politics, all of those are on the right track. It's a long-term trend, but you are going to get volatility within that. That whole story of if the rest of the world catches a cold, Africa will catch a flu. To a degree, it still is valid. You get risk off, and when risk off happens, we've seen it. COVID, Russia-Ukraine war, now with Iran. When you have that big risk off, people just sell. There's a lot of, I'd say, shorter term money in Africa on the equity side. What we would call tourist investors, your large global emerging markets funds who would maybe buy one or two shares. And then as soon as things look a little bit dicey, will pull out. So you do have that volatility. But what we've seen, and a big part of our ability to generate alpha over and above the Africa benchmark is as a result of that volatility. It gives you amazing opportunities to invest. We can touch on it in a moment, I'm sure we will, but those periods of volatility, whether it be because of what's happening globally or currency repatriation issues, have given us the opportunity for that alpha. Since the start of the fund in beginning of 2014, our Africa XSA equity fund, we've beaten the market on a net basis by about 6% per year. And it's that perceived risk that's higher than the actual risk, we think, and it's those periods of volatility that enable you to invest in companies to get returns like that.
And obviously, Africa is a different opportunity set from a stock market perspective compared to South Africa and the likes. So what is, maybe if you can just unpack for us your investment style, how do you approach investing, picking the stocks in Africa, and how do you construct a portfolio that is done 6% alpha annually?
For us, the key is to be a long-term investor so that you can weather those storms I was chatting about earlier, and those is what gives you the opportunities. We are, at the core of what we do, fundamental company analysts, bottom-up stock pickers who are looking for undervalued shares. As simply as that. You can't bucket us, I think, as deep value or quality growth or something. We're all of those. We find value in 2 PE bank stocks in Nigeria during times of currency crises. We find value in 17 times PE fintech in Egypt right now, things like that. So for us, you've got to be long-term investors. Our fund has 60-day notice period. We would never run an Africa fund that's daily liquidity or weekly liquidity because your opportunity set is just too small then. Liquidity is an issue in Africa. I'll give you an example. Africa trades right now on about an average of $140 million per day. Which is not bad. It's good for a fund like ours. We're about $450 million right now with that 60-day notice period. But something like South Africa trades $1.5 billion a day. So more than 10 times Africa. And that's what differentiates Africa. It's still very much a nascent frontier markets, the countries, versus even a well-established EM like South Africa. But it's also what gives you the opportunity. Most people globally are looking at your larger EM markets, including South Africa. And there's not that many people actually looking at Africa ex-South Africa. So again, in there lies the opportunity. It lies the opportunity to invest in great quality companies that you want to hold for the long term, as well as generate alpha over the overall opportunity set.
So, you mentioned something, interesting. You talk about liquidity and some of the opportunities in there. So whether a manager is a bottom-up stock picker or a top-down stock picker, how much of that political lens or do you apply? Because obviously in Africa, in these regions, high in conflict, political systems tend to be struggling with stability and all these types of risks. How much of that do you actually, apply when you are constructing a portfolio?
Sure. So we, when we look at what we do from a day-to-day basis, how do we spend our time? About 80% of what we do is spent looking at companies.
Yes.
Just bottom-up analysis. But we obviously have to be aware of the macro tailwinds, the macro headwinds. As cheap as things are, you don't really want to be where there are too many macro headwinds. You do want to be where there are macro tailwinds. So we will probably 10 to 15% of our time spent looking at the risk factors, at the macroeconomic factors, including politics there. One of the key things we do look at is currency. Obviously, that everything feeds into currency, inflation, interest rates, your deficits, things like that. So, and that is one of the risks. Obviously, being a US dollar fund, you've got to know what's happening with currencies. It's no good investing in a stock that does amazingly in some local currency that's constantly depreciating, so your dollar return's not that great. So we'll spend a fair bit of time on that. And then the remainder, kind of 10 to 5%, is spent looking for just pure special situations.
Okay.
Africa is still, as I said previously, still very nascent, developing markets. The exchanges are still very frontier. So you do get some great pure special situations, arbitrage opportunities, things like that. So I think as Lorium, one of our strengths is to not only find those opportunities, but to be able to execute them. We've got a very strong operations team that are able to put those type of trades on. So from a portfolio structure point of view, we will look to have roughly 25 names in the portfolio, fairly concentrated.
Yeah.
And then we will try spread risk. When we're thinking of spreading risk, we will diversify more across countries rather than sectors.
Okay.
What's happening to a bank in Ghana is very different to what's happening to a bank in Egypt.
Yes.
The fact that they're both banks actually doesn't really matter. Sector risk is not your risk. It's really country risk. So that's what we will focus on. We are benchmark agnostic, but we also are aware of the benefits of diversifying across multiple countries, just to avoid massive downside risk in any one country.
I mean, you mentioned benchmark agnostic. Obviously, Nigeria, one of the regions within the index in Africa, was excluded from the index, and now there's talks that it could be reintroduced back into the index. What are your views on that in terms of 1 minute you have a regional exposure, and now you're stuck with that exposure, and that's an off benchmark bet. So what is your view on that region? And
a couple of things. Firstly, as I said, we're benchmark agnostic, so it doesn't matter. We don't care to a large degree. But also the so Nigeria was removed from the MSCI index.
Yes.
We've long thought that you obviously need a bench, as much as agnostic as we are. You need to be able to a scorecard to see how you're doing versus what's out there. And we've found the MSCI to be not the best index, to be honest. MSCI Africa, South Africa. It's very highly concentrated. It is prone to doing things like removing Nigeria at exactly to the month, the wrong time, and then taking forever to put it back in. A lot of the Africa opportunity set is also listed elsewhere.
Okay.
So the resource stocks tend to be listed in London and Toronto and Sydney to a lesser degree. There's a lot of Pan-Africa type stocks that will list in London as well, such as your Tower Coast, Helios Towers, things like that. So the MSCI only looks at stocks that are listed locally on African exchanges. So in our view, and again, other people have different views, our view is that it also misses a big part of the opportunity set.
Yes.
So our benchmark index for the fund is less concentrated, and will include some degree of resource stocks. It's also capped at stock level, 10% stock level as well as country level. There'll be a 30% country level stock. So you will have, again, what we think is a more representative view of the investment universe.
Yes.
Whereas the MSCI tends to be highly concentrated at times.
Okay. No, that's a very interesting one. And in terms of Africa, what have been some of, I'd say, your best learnings from Africa, especially, investing in such a niche space? What has been some of the things you've learned, or some of the things you've learned a hard lesson?
Yeah. So I think, again, I mentioned currency. Again, but it's very important for what we see, both risk as well as opportunity.
Yes.
The opportunities that we've had during currency crises have been a big learning. Obviously, when you're in the midst of one, it feels bad, it feels horrible. That old saying, when there's blood on the streets, you should be buying. That doesn't actually happen. When there's blood on the streets, everyone's panicking and running away, which often can be the best strategy, is to run sooner. But if you are a long-term investor able to weather those storms and have long-term investors into your fund, which we are lucky enough to have some very strong partners, long-term investors such as yourselves, you can weather those storms, and you can buy amazing companies on extremely cheap valuations just because everybody else is panicking, everybody's leaving. That gives you that opportunity. Flows, what happens as well is the local investors, your local pension funds, during times of crisis, you have your interest rates will go up. So your pension fund investors will also sell out of the equity market to put into bonds and bills. And so you get locals selling, foreigners selling. So if you can stay, you can pick up some really, really, really cheap stocks.
Okay. And in terms of, let's look at broadly Africa. I mean, we saw Africa Q1 was also really over a 1 year period, delivering stronger returns than the rest of the markets. What has been that driving factor that has been driving the African markets? I think Ghana was one of the best regions as well. So what has been driving that? Is it more of a resource story, or maybe sector specific, or?
So I think you got to go further back than that to see where we've come from, where the base was set. And there's no doubt it was a very low base for a long time. Africa, and again, I'm going far back here now, did really well. There's obviously the global financial crisis, a bit of a blip there, but then there was a lot of money post the GFC going into Africa, a lot of foreign money, till about 2012, 2013, 2014. After that, the money started leaking out again, and it was a couple of tough years, a tough decade. Things weren't too bad. We're fine, and started recovering into 2017, 2018, 2019. Then we had COVID. Big sell-off during COVID. Again, flight to quality, risk, global risk off. The whole of Frontier, the whole of EM got hit hard. Africa was not immune to that. You then had the Russia-Ukraine war. That caused a spike in energy prices. A lot of these companies are energy importers still. Egypt, Morocco, Kenya, Nigeria theoretically should benefit, but they were subsidizing their petrol to such a large degree that they actually did not benefit from higher oil prices. It was just a crazy situation. And then since then, you've had a lot of things come right all at once. So in Nigeria, there were some big economic reforms, a new government in place. They got rid of the fuel subsidies. So now Nigeria does benefit from higher oil price. You also had reforms within Egypt, Kenya to a degree. There was a resolution of a lot of the debt issues. They kind of slowly worked their way out of the debt with the help of the likes of the IMF and the World Bank, who were extremely supportive over those times. You then had, again, on the economic reform side, you had Egypt and Nigeria liberalized their currencies at the same time. That was in about March 2024.
Yes.
And after that, you had money coming back into what was very cheap equities. You had companies growing earnings strongly as a result of that. Interest rates came down. It was just a better earnings environment for them. And then lastly, you can't ignore the commodities and the dollar. For many, many years, countries have been facing a strong dollar.
Okay.
And that feeds back into currency. So companies were growing their earnings very well, doing what they said they were supposed to, doing a phenomenal job in local currency.
Yeah.
But with that constant headwind of dollar strength, it was tough to translate that into dollar earnings. Over the last couple of years, the dollar has, I'd say, stopped strengthening. It hasn't been not just one-way traffic anymore. We don't like to take too strong a view on currencies. We have no idea. But we feel that the days of just constant dollar strength are over.
Okay.
You're going to have dollar stability, and if all goes well, a bit of dollar weakness from here. That'll be a tailwind to the economies, to the currencies, and it's a big tailwind to the commodities as well.
Okay.
So you'll have oil price should be okay for the likes of Nigeria. Things like gold, copper, other base minerals in the rest of the continent will be supportive. So a lot of things have come together. But I think one thing I would like to say as well is we've had a very strong last 3 years.
Yes.
We're up about 34% per year in dollars. The fund, the index is not too far behind. We've beaten the index, but not too much. The index has actually done very well as well. I'm sure a lot of our peers have done pretty similar numbers, but you still are on very cheap valuations. So it hasn't just been a low quality PE rating. It's not like our bank in Kenya has gone from a 2.5 PE to a 7.5 PE. It's gone from a 2.5 to 3.5.
Okay.
But there's been very strong earnings growth, and the earnings growth trajectory from here still looks very good. So for anybody not in Africa looking at it going, wow, I've missed the rally here, all you have to do is look at the valuations and the earnings forecasts for these companies over the next 3 to 5 years, and you'll see things are still looking very good.
And I guess with the African markets, not a lot of people know much about what's happening in Africa and the African markets. What's that one thing that you think people are misunderstanding about Africa or the African market?
I think it's that risk. I think, again, it sounds like a little bit of a cliche, but perceived risk is bigger than actual risk.
Okay.
Sure, there's volatility, there's currency issues, there's some political upheaval, but it's actually not as bad as it's made out to be. And if you look at a lot of the companies on the ground, they are still growing their earnings well through all of this. They're still very cheap. And then secondly, it's a great stock pickers environment. For us at Lorium, it's probably the best stock picking environment across our whole firm because there's so few people looking at the rest of Africa.
Yeah.
It's a great environment. This is both buy side and sell side. Given what's happened in Africa and kind of just COVID and the last 6 years, a lot of the Africa funds have actually disappeared. So funds like us surviving, there's fewer of us, it's a better place to be.
Yeah.
That's actually that's the bull case. If you look at the sell side, I mean, there's a company I was looking the other day called Sonatel, based in Senegal. That is a francophone West Africa telco operator, good quality company. It's effectively in hard currency because the West Africa franc is linked to the euro. There used to be probably 7 sell-side analysts or firms that covered it. If I go back 10 years, there's now, I think there's 1. So you've just had attrition across the board in people looking at Africa. And again, that's what gives us that opportunity. That's what makes it an amazing stock picking environment.
Okay, awesome. And I mean, in closing, what is the one thing that you'd want people to know about your portfolios, Lorium, and anything you'd like to share from insights, risks, opportunities?
Yeah, I think a lot of it boils down to people and
Yeah.
team. If you think about, we've done pretty well since inception, early 2014, but is it replicable? And for me, the key there is the people
Yes.
involved. We've got, if I got hit by a bus tomorrow, the fund would carry on absolutely fine, no problem. We've got
Touch
very
wood.
strong people. Yeah, you know Tinashe,
Yes,
he's
yes.
assistant PM.
Yeah.
And we've got a couple of the analysts who will look at South Africa and rest of Africa stocks as well. Our banks analysts, for example, will look at banks across the whole continent, including SA.
Okay.
Same with telco, same with resources. And that's what it boils down to. Do you have the human capital to actually spend the time,
Yeah.
go to these countries, do the work? And at Lorem, I think we very much do.
Okay. No, thank you, Paul. And there you have it with our installment of Meeting of Manager Minds, where we've unpacked some of the opportunities and risks within the African market. And stay tuned for our next episode. Thank you.
Thank you, Susie.
Thank you,
Thank
Paul.
you.